Welcome back to the Real Estate Standard Podcast, episode 19, where commercial real estate and Bitcoin collide. I'm Tim Kotzman. I'm here with Kenny Alves and Chris Drizga. Each episode here, we endeavor to break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we're discussing the benefits of solar power. And first, I'll kick it over to Kenny for an update on Westmain Storage stacking.
Thanks, Tim. As of today, May 11th, we hold 4.5 Bitcoin. So far this year, we've stacked 2.38 Bitcoin, 238 million Satoshis. Year to date, our Bitcoin yield is a little over 100%, 108%. What does that mean? We've doubled our Bitcoin since January. Bitcoin per square foot is on the rise. It's at 6,580 Satoshis per square foot. And just to give some context, there's about 97 billion square feet of commercial real estate in the US. So if you were to take all the Bitcoin in existence, 21 million that will ever be, and divide it by all the US commercial real estate, you'd only have 21,649 sats per square foot. So it's pretty scarce, say the least. Our Bitcoin holdings cover over 16 months of mortgage payments now. So we're looking good there. And earlier this month, we received our third digital rent payment from Strategy for $1,960. That's roughly a 3% increase in NOI. And the equivalent are 7 storage units. And that's the report for today. What do you think, Chris?
You've spent the last 6-8 months or so, building this, and the foundation's laid. The flywheel is spinning, and I think it's only picking up speed. Oh, sorry about that. It's only picking up speed. And you kind of see just some of the metrics that you're rattling off there, Kenny. The last couple of weeks, these small moves in the Bitcoin price are translating into really noticeable material improvements on or for Westmain. So it's going to be really exciting to watch this thing tick up back into the 90s, 100,000 plus range, and wherever it goes from there. And again, bringing it back to the real estate, it's the flywheel is spinning, and it's really, really fun to track it in real time like we are. So those are my thoughts on that.
Yeah, I will say that, this just kind of reinforces the dollar cost average, guys out there. When we first started buying Bitcoin, we were getting 8 million Satoshis a week. We've been keeping the same dollar amount every week. And, in February, we had a week where we got 15 million Satoshis, nearly doubling where we first started. And our average cost is in the 80,000 range. So we're, I think we're only like within 10% of our cost basis, but we were able to accumulate over the better part of last year and this year so far.
Yeah, absolutely. Any consideration for selling any of that high basis Bitcoin?
I wanted to kind of maybe do something this week and sell some Bitcoin, but it's already in safekeeping, and it's kind of a process to get it back on an exchange and do it. And we're only down by a small amount. I mean, I guess some of the higher costs, but we really still have a small treasury at this point. We're still only at 420,000 after tomorrow's weekly purchase. So, it makes more sense for someone like Strategy to do that, because they're picking up a couple $1 billion in tax loss harvesting, where we might be able to get tens of thousands of dollars. So, I mean, the pleb inside me wants to go pick up the tax loss, but I think we're not going to FOMO on that just yet. We're going to stick to our plan. We got some exciting news in the next week or so, maybe even this week if we can move fast enough.
Yeah, I mean, I was just kind of saying that, tongue in cheek, I suppose, on the back of the strategy earnings call here. But and I agree with you. I think the best course of action for Westmain is to continue the DCA. You have all the conviction in the world, and you're seeing the results in real time. So I don't think you need to get cute with any tax plays just yet. But I think that brings up a more interesting angle. I know we've talked a lot about different tax strategies here the last few weeks or so, but for the real estate folks out there that maybe aren't as into all of this as we are, the fact that Bitcoin is classified as property, and that the wash sale rules don't apply to it, creates an interesting tax strategy, tax arbitrage component to the overall operation, the overall business plan and strategy. So keep an eye out for some of those different maneuvers in the future, whether it's from the Westmains of the world or the strategies and strives of the world, everywhere in between. So I think that's a good point, a good chance to pivot here, Kenny, into today's topic, which I know you have some personal experience on, and that's solar power, and the strategies that real estate owners should be thinking about, and really the pros and cons that come with it, and when you layer in Bitcoin on top of this solar strategy, it becomes all that much more interesting and beneficial. So I'm going to kind of, what are your thoughts on this whole solar thing? I know you got some personal experience in the space, but also, Westmain's got some panels on the roof as well.
Yeah, lots to unpack. I know we've mentioned it a few times on the show, but we never really dug into it. So I thought today would be worthwhile to spend some time talking about solar. We got involved, I think it was almost 11, 12 years ago in solar. And West Main actually has two solar arrays on the roof. So it just looks like one, massive array covering as much square footage as we could. But it was installed and as far as the utility is concerned, it's two separate arrays. The first one was designed and engineered to offset our energy footprint. So we were averaging about $2,000 a month in electricity, and so 24,000 a year. And so the thought here was, one, if you eliminate an operating expense and self storage is at like around the 5% cap rate, you are increasing your NOI by eliminating an expense. So basically, it's 20 times every dollar that you generate gets a 20 times valuation at a 5 cap. So being able to cut 24,000, you multiply that by 20. I don't like to do live math, but I think it's around like 400,000 um, in value by doing that. And what made the deal sweeter at the time was there was a state incentive, so that there was a cash grant, and that came out to like 25-30% of the system cost, if I remember correctly. And then there was the federal investment tax credit, which is sunsetting. No pun intended there, but it's it's sunsetting and going away. And you could, back 10 years ago, you could get your investment back in 2 years when you factor in all the tax benefits, the federal tax credit, the accelerated depreciation, which real estate investors, love depreciation because it lowers their tax obligation. And then the energy was more of like, the icing on the cake. And so that's one perspective. That's one way to look at the solar was was to offset your energy use. The other way is to look at the tax ramifications, which if your building's older and you don't have any depreciation left, you may be looking for ways to get depreciation and tax credits. Now, the second array was purely to generate additional cash flow. So all the power generated from the second array, which is larger, the first one was about a 79 kW, and the second one is about 3 times larger. It's 221 kW. And all the power generated is sold to the utility company at a fixed price per kilowatt hour at about 26 cents a kilowatt hour. So that generates about $60,000 in cash flow. And you get we installed this a while back, so we still had the tax incentive, the investment tax credit, the 30% on the total cost, and the accelerated depreciation. But now you have this cash flow, and when go to a bank to refinance your property, you can they're willing to lend. Not always, and not all banks are willing to lend on it. And it took a while for the banks that we work with to lend on it, much like we're kind of going through with this digital credit thing now. And I want to kind of draw a comparison to that here in a second. But that 60,000, if we do the same kind of math, right? And you're at a 5 cap, you just added $1 million in value, 1.2 million to the valuation of your property, and this is like an ancillary income, right? And we've seasoned this income for the first solar array didn't really need to be seasoned because it just kind of creeps in because you eliminate an operating expense, and so you don't really need to explain the solar. It just your expense just goes away. But with this one, we have to educate the banks and lenders. Like solar power, we have a 20-year power purchase agreement with the utility that's going to buy all the power from us that we generate in that period of time. And yeah, so I'll pause there because I'm sure, Chris, you're going to have some questions on and try to make sense of all this.
Yeah. I mean, sorry, go ahead, Tim.
I was going to say, be careful, Kenny. I might have a question at some point too. Over to you, Chris.
Yeah, you're free to ask at any point, Tim. I know that you got a sore voice. I think you were doing karaoke or something in the UK.
I mean, you got an energy background as well, Tim. I mean, I think it's a really interesting topic, really fascinating topic, and way to incorporate it into the real estate. To your point, Kenny. I mean, it's not just a clean sustainability play anymore, right? There's a tax component, there's a value creation component, and a way to attract and retain tenants. It's really a multifaceted strategy essentially for the real estate. And I think I ended the episode last week with Leon saying the 4 or 5 different categories that real estate investors and operators were going to have to excel in order to stay competitive into the future. Energy is one of them. And just by going through your experience there with Westmain and the setup you guys have, I mean, that's a full-time job in and of itself, just to understand it, the different options available to you, be able to negotiate those PPAs, and operate the solar arrays to begin with. The other point you made there was really kind of underscoring the additional income streams, right? And we've hounded on that a lot on the pod here. Particularly from the digital rent perspective with some of the digital credit products. This is a perfect example, right? I mean, whether you're charging for parking or you're charging for additional storage, what have you, you can very well create a revenue stream through the solar panels as you described there with the second array. I think me just coming from my my limited experience with solar, I always looked at it as like an operational defense, right? I looked at it from the standpoint of my operating expenses are increasing, X% a year. They're outpacing the fixed rent escalations that my tenants have. What can I do as an owner to make that as efficient as possible? Right? What can I do to offset or make the energy consumption just a touch more efficient to be able to squeak some additional NOI out of the asset? And I mean, when I was researching this topic for today, it really was kind of eye-opening on all the different angles you could take. So
Yeah, and I mean, for us, the reason we got involved was the tax savings. And what I wanted to try to connect today is digital rent and solar. Or like, I feel like 10 years ago, the smartest real estate guys, the smartest real estate operators that I knew were adding panels to their roof, because another incentive during that time that I didn't mention were, and they're still active in some states, renewable energy credits. So in addition to all the incentives that I mentioned, the grants and everything, and there's also state incentives in addition to the cash grants, where renewable energy credits are generated for every megawatt hour. Every 1,000 kilowatt hours that you generate, create a renewable energy credit, and those are traded um, on open markets. And there's like big corporations that buy these credits to meet their ESG narratives. Maybe not so much anymore, because that kind of got abandoned. You don't really hear the ESG talk as much anymore. But there's this whole like secondary market for these renewable energy credits. So if you're like a big like carbon um, emitter, like you can still get your ESG certificate by purchasing X amount of renewable energy credits, and those sold at different rates. So in Rhode Island, our renewable energy credits were only trading for like $20 or so a credit. But in Massachusetts, where we have some other property and have some other solar arrays, their SREC program, solar renewable energy credits, were trading at $280 per credit. So, and they went on for like a 10-year period in Massachusetts. So when you install the system, the SRECs alone were like, you recouped your money and profited over those 10 years, never mind the electricity you produced and the tax incentives and whatnot. So um, when I look at digital credit today, and when you pair digital credit with real estate, I think that's what creates digital rents, because you can borrow against a long duration asset, real estate, and the interest payment is a tax deductible. So you pair that with the income coming in, that's return of capital from these digital credit instruments, and you essentially shield all your income. If you max borrow on the property, and you can get interest only terms, which is becoming more common, with even community banks willing to give you a year or two of interest only. Um, that interest only is completely deductible if there's no principal. And so if you can max borrow on that, you can reduce what you showed for rental income, and then like kind of transform it into this return of capital that's just much more tax efficient. Now, you got to be a believer and educated on Bitcoin, or you think this is like a high risk kind of speculative thing. And that's where we kind of are today, where you know um, the people like us that are engineering these digital rents, we're getting looked at like we're crazy, like we got like six heads or something. And um I think we're just early, and like people just don't understand the fundamental thing that backs or powers the digital credit, which is Bitcoin.
Yeah, I mean, I hound on people or just in the industry a lot about the over financialization that has taken place the last decade plus in commercial real estate. And I think one could make an argument here that the different strategies that we talk about is financial engineering to the nth degree, and maybe it is, but we're not we're not doing all kinds of financial engineering to make the deal pencil, right? We're underwriting real estate as it would be in any other traditional sense. Does it make sense on its merits alone? And then from there, if you can check that box, from there we're trying to integrate all different kinds of creative strategies, whether it's an income approach or an income stream, or a tax strategy like you're talking about with the return of capital dividends, the depreciation from the solar panels or any kind of other improvement. And I think that creates some really interesting opportunities for owners of all kinds of real estate, particularly the owners of older properties, right? I mean, I've been a big critic of people that own older assets, maybe Class C or Class B assets, where I've said just get rid of them, right? Even if you got to take a haircut on it, the liquidity has a lot more value than having that capital locked up in a illiquid asset. But now you start to think about some of the strategies here, whether it's solar or digital credit or Bitcoin stacking. If you can use that real estate in the interim to serve as that foundational element in your flywheel, that becomes, maybe it's not an all or nothing type of proposition anymore for some of these older buildings.
Well, I think you just mentioned something important that I haven't actually heard it like articulated that way. Um, but it's kind of, taken for granted that we're not relying on the solar, we're not relying on the digital credit for the deal to pencil out. We meet the DSCR, and we meet the criteria just with the real estate cash flow. And so what we're trying to do is exactly what you said, is optimize here. And like, I think a lot of people don't, maybe look at it like, from a certain angle, and they don't get the full picture. Maybe kind of like you explained that you were looking at it more from not necessarily adding value, but kind of just reducing an expense. And just to give you kind of more perspective into this, the second system that we installed, the one that's a feed-in tariff that's selling the power back to the utility. We self-developed all these two, because like building solar is just one component. It's like hiring some electrical contractors and subbing it out. It's just like one component of general contracting. Um, but our cost for that system was about $500,000. I think it was $525,000. Now, when we went to refinance, we didn't like tell the bank what it's worth or what it costs, or how we value it, right? They look at that $60,000 in cash flow, and they give it the same cap rate that the real estate gets, which is like around between a 5 and a 6, depending on the lender, right? And so they're valuing it right off the bat. We paid 5 and a quarter. They're valuing it at 1.2 million. So you just built in, like you basically got your money back. You doubled your money just building the thing if you refinance and pull the equity out. Um, so, I mean, I think like when you compare commercial and you compare residential, it's night and day. Residential is, people compare that to, Bitcoin and Stretch and digital credit, and that's one thing. But when you're looking at it from a business perspective, from a cash flow perspective, much like how residential real estate and commercial real estate are, completely different beasts. Um, it's a whole different animal. So, um, yeah.
Yeah, I think that came through, particularly in the commercial realm, with all these institutional operators really across all the property types that have notable solar exposure or solar strategies on their assets. Prologis is I think they're the world's largest industrial property owner. They're a publicly traded REIT. These guys got 100,000, 500,000 square foot facilities for distribution manufacturing across the country, across the world for that matter. Those are huge roofs, right? And if they're in an area of the country, California, Texas, Sunbelt region, where you're getting a lot of sun exposure throughout the year, that's meaningful, right? Just like we were kind of talking about what it would take a public storage type of operator to eclipse Westmain in the Satoshis per square foot, right? It's kind of the same thing here. Those guys have such a scale with their existing portfolios to add solar and create additional revenue stream, or even just offset the operating expenses. But I think that is, to your point, Kenny, the fact that it's not. It's very much an apples and orange comparison, residential versus commercial. There's a lot more nuance and ability to create value in the commercial realm, and I think a lot of people are maybe overlooking it to some extent.
Yeah, and so I mean, trying to kind of circle back into where we are today with digital credit, because I think that's one of the most important things to be discussing. What is it going to be like adding digital credit? And I think we can learn a lot from solar, because when we were putting solar on the roof, the incentives were the greatest, right? We were it was under the Obama administration. They kind of championed the renewable energies, and that's where they wanted entrepreneurs to focus, right? They wanted business owners to focus on renewables. And the Trump administration says that they want the US to be the US Bitcoin superpower of the world. And so you're seeing entrepreneurship trend to where the incentives are the greatest. And we're seeing innovation. And I think, this rock dividend structure, which was a happy accident, really. Like, Strategy didn't realize when they were creating this product with AI that it would qualify. I remember when it first came out, people were asking, well, is this going to be qualified dividend income? Or is this going to be regular dividend income? And it was going to be like a 5% difference, right? If it's qualified or regular or whatever, ordinary, I think it's the proper term, ordinary income or qualified. And it turns out it was even better. It's like too good to be true. And I actually, for a short period of time, for 3-4 years, while we were building solar arrays on our own properties, I was offering that as a service to other commercial property owners in our market. And I would go with these presentations that show that they get their money back in 3 months, or 3 years rather. Um, and I would have people say it's too good to be true. It's too good to be true. And in order to sell these solar arrays, I literally had to make the deal worse. I had to charge more money. I raised my cost up. And then people were like, okay. And I feel like that's kind of like what's happening with digital credit. It's like, oh, 11.5%. That's too good to be true. No one can pay 11.5%. Maybe if it was 8%, I would buy it. And I just feel like history always rhymes. It doesn't necessarily repeat, but it rhymes. And I can just see the similarities between the incentives for solar energy 10 years ago and digital credit today. And it's like two different. I think it's actually the learning curve for digital credit's going to be easier. The solar, like you were just saying, is so nuanced. You have tax components, you have the energy component. What if like the system stops working and the sun doesn't come out? Like, what happens, kind of thing. And like uncertainty. Like, you're underwriting the sun. So
Watch out, Kenny. Bill Gates is trying to block the sun, so that could be a real risk. Might have to underwrite it.
I did see some article a while back about that. Yeah, I mean, So, I mean, you got the kind of like a, just the same kind of like criticism. Like, what if the sun doesn't come out? Like, the solar panels aren't going to make any electricity. And it's like, what if Bitcoin goes to zero? It's like it's like the same thing. The sun's going to come out, right? The sun will be out tomorrow. Just ask Annie. And Bitcoin's not going to zero. So, like, the risk is very minimal. Like, the risk reward for both of these things, at solar 10 years ago. Now, solar today isn't as attractive as it was 10 years ago, right? And I think digital credit will be the same way. In 10 years' time, it's still going to be great. People are going to have it over having cash in a bank account or a savings account, right? But it's not going to be double-digit return. I don't know if it's still going to be double-digit returns in a decade. I think we'll see that come down as it gets proven out. I think it's better now, just like solar was better then.
I think that's a good point I think Tim has a special message for us.
Yeah, we're going to take a quick break and be right back. Quick note for property owners listening to the show. If today's discussion sparked questions about how these strategies might relate to your own building or portfolio, we're always happy to have a conversation. No sales pitch, just a thoughtful discussion about your property, your capital structure, and the options available in today's market. You can find our contact information. And we're back. And we're back.
And
My
we're
voice
back.
is not back, but we are back. It was
Yeah.
so over, but now we're back. Back to you, Kenny.
We're so back. We're so back. I think that there's, like we were saying, a lot of overlaps and with solar tax and the tax benefit. Stumbling on my words here, but the tax incentives are very similar. Like, the reason to consider digital rent as a real estate owner is the tax impact. And we've been modeling out this refi that we've been planning for months. And the after tax cash flow increase is significant. We're projecting over 50%, but we may decide to allocate Bitcoin heavier, and you can kind of reverse engineer how you want that taxable income to look. So you kind of you can use digital credit as a lever. Like, you add more if you want to lower your taxable income, and add less if you want to show more taxable income. I mean,
You got these
I feel like
dials,
I'm
right?
yeah.
I know exactly what you're saying. It's like Sailor says it all the time, right? We have our hands on the controls, and we can choose to dial up or dial back, given the market conditions or, whatever set of circumstances is in front of you. And I think that's exactly what you're getting at, right? For the other thing too, I mean, we've been talking a lot about the incentives on the back end, but I don't want to overlook the incentives on the front end. Right. I mean, a lot of people say, oh, well, that's, to your point, when you were selling solar back in the day, Kenny, it's like this was too good to be true. Or maybe it's like, I don't want to incur that upfront capital cost, right, to do all of this. Right. And I think people would be pleasantly surprised at all the different programs and incentives that exist to offset that upfront capital cost. Right, whether it's there's specialized lending and financing programs that you can utilize to acquire the panels and do all the installation, all of that up front. And to your point, that's just another consideration. Just like you model out your refinance for the loan, you model out this just like you would anything else on the deal or across the portfolio. So when you actually start to look into it, not only are there tremendous revenue and tax incentives on the back end, those incentives exist on the front end as well, where you can get really creative and probably I don't want to say come out without making any upfront contributions, but very negligible upfront contributions at the end of the day.
Yeah, there was a big push for like the C-PACE loans where you could borrow against you could put it basically against your do a lien against your property and you'd get the financing to do it. Yeah, there's a no shortage of lenders in the space.
Yeah. And I mean, again, I think it's important to just note here too that it's, very dependent on the market you're in. It's very dependent on the type of property that you have. Let's not forget that all these different property types have different types of leases as far as, which party is paying the expenses directly or indirectly. So you obviously, it's not a, one size fits all. You definitely have to evaluate your existing situation and your market, before you go full steam ahead with something like this. But the other things too, it's if you can get past those first 2 points, you also have to understand the condition of your roof, things like that, the demand charges, the tenant profiles, state and federal incentives. So there's all kinds of stuff. How the lease reads, right? There could be some nuances to the lease itself that you need to take into consideration. So it's definitely not a don't walk blindly into this endeavor. There's a lot of work you need to kind of take on here. But if you're willing to put in the effort, I think you'll really benefit on the on the other end.
Yeah, I think you hit on something else that's important. I think a lot of property owners that are not running an operating business from their building, they may overlook it and say, "Oh, well, I don't have any energy bill to offset, and it's a triple net lease, so I don't have any use for the solar." But a lot of states now have what I was talking about earlier, a feed-in tariff, where you just contract with your utility company to buy all your power from you. Other states, like where I was in Massachusetts, they had one of the best policies throughout the country, and they had net metering, meaning you could sell the power to any other business or any other meter in that utility load zone. We have a array in Massachusetts where we sell the power to a chain of Hampton Inn hotel, and
Interesting.
you can get creative with how you structure the power purchase agreements. And we happen to do it in a different way. Most people at the time were doing a fixed price per kilowatt hour, and they were discounting it um, you know, 10-15% below market rate and locking it in for a 15-20 year power purchase agreement with the end user of the power. And we decided to structure it a different way, kind of like a variable rate in which we just did a higher. We gave our end user 20% off, but what we did was we let the utility company creep up the rates over the past 10 years, and they've raised it a lot more than 20% since we started the one in Massachusetts. So we benefited from that increase in rates too. So there's a whole bunch of ways that you can get involved in and like really um, squeeze the rag, so to speak, and try to maximize, because it's really important once you understand that every single dollar is a is being multiplied to come up with your property valuation. And so you see guys like adding vending machines, right? And it's like, oh, it's like making an extra $1,000 a month or whatever, but they're seeing a much bigger number, right? And I think that's what separates the good operators from the average operators. They're just looking for every way in which they can increase their NOI. And this digital rent thing and the solar was like the last big one, right? And this is like the next big one is digital rents. And that's, you know, that's just another way to look at how you're gonna underwrite these deals, because if you know that you can park, um, security deposits or, your cash flow and digital rents and Bitcoin, you're gonna be penciling out a different deal than everybody else. So I know we talk about that a
Yeah.
lot, but I think it's,
You're
these are the tools.
you're going to see, I mean, I hate using the word, but you're going to see a bifurcated market to the nth degree. I mean, we're already seeing that here today in today's markets the last couple of years, but you're going to see that get, exacerbated, extensively, because to your point, Kenny, you're going to see properties that are printing, whether it's annual cash on cash returns or, exit values, exit returns, whichever one, they're going to be so far and above the quote unquote market returns that it's going to demand attention, right? I mean, and I think that's something we've hammered on the pod, repeatedly too. Is we feel like we're crazy banging our heads against the wall here, for the topics and strategies that we're exploring, but to some extent, or to some point. There's the education process, but it's also going to be just a matter of time, right? We got to let these things run their course, and we're going to get to a point where our returns are so, much more advantageous than the rest of the market. It's going to demand attention, right? We're going to attract capital disproportionately, and we're going to be able to weather fluctuations in the market, a lot better than those that aren't, implementing these types of approaches. Being a real estate Bitcoin show, I think we'd be remiss if we didn't like bring up the possibility or the optionality that Bitcoin mining has here too. I mean, I always think when you have solar panels, you have this battery technology now as well. I mean, you have this. It's not just a use it or lose it proposition anymore, right? I mean, you can utilize the battery technology to store the energy that you're producing. What do you do to that, or do with that? To your point, Kenny, I mean, could you sell it to the neighbors or the Hampton Inn down the street? Sure, right? That's an option. Do you sell it back to the local provider? Potentially. Maybe you hook up a couple S19s and mine some Bitcoin with it, and offset either offset your expense that way, or create an entirely new revenue stream. I'm excited about that, and I think it kind of goes to that point we've been talking about, is turning this single purpose monolithic asset into this financial machine that's designed for the 21st century. I think it's a really exciting proposition.
Yeah, I think for off-grid properties and, if you're in a territory where the utility doesn't have a solar program or there is no net metering, I think, mining is a real unlock, right? Because often if you're buying property that's like off grid, you're gonna get a cheaper property. And like this is a real way to monetize it. I saw a guy on X, I think it's his account is like 100 acres or 1,000 acres or something like that. And he's doing off grid mining using solar energy, and he's using direct current DC power. So he's not converting the power to AC, which is required to, use most appliances and stuff. He's doing it through direct current. And I think for setups like that, and it also depends on the cost of electricity where you're located, right? The cost of electricity in Rhode Island, where Westmain Storage is located, it's expensive, and the utility is willing to buy it back if you generate it at 26 cents a kilowatt hour. And the Bitcoin network you'll hear people say it's the buyer of last resort, and that's because it's really like, it's like single. You're like, if you do the math, you're getting like single digit, kilowatt per hour. So like you might net like 3 to 7 cents. So for us, like in New England, I know like it's different if you're in a southern state that has more sun. That's the other thing. Rhode Island doesn't have as much sun as a place like Texas or Florida. And so you normally see the energy costs kind of correlated with the with the sun production too, which is an interesting thing. But certainly when you're in if your power cost is less than 10 cents a kilowatt hour, that's when it could start making sense instead of selling it to your neighbor to mine it, because you may be like paying a little bit of a premium for that Bitcoin, but there's benefits. It's KYC free Bitcoin that may be worth more to you. And you're getting a better understanding of how Bitcoin works, how to hash. Learn about um, the mining
You
components, the
deepen your
hash
knowledge of the
boards.
network. Yep,
Yeah,
exactly. Deepen your knowledge. I mean, as you were saying that, I was kind of thinking through, the acquisition strategy that we've talked about here before, right? I mean, obviously, Bitcoin friendly jurisdictions is front and center, but now, maybe another consideration is not just a low cost energy jurisdiction, but more importantly, a jurisdiction that has 9+ months of sun exposure a year.
yeah,
Just a
I think
thought.
that I think that there's tons of interesting ideas, and it all ties back to real estate, right? Because you need to occupy physical space to mine,
Hmm.
right? Like you need land, or like you need to either rent or own some land to be able to mine. So it like real, you know, you can't store your Bitcoin in cold storage without real estate, right? Like, or you could in your brain, but that would be kind of reckless to not have a backup of it. Um, and so, like, even with self custody, you need real estate to store it. Like, you think of safe deposit boxes, right? And that's been phased out by banks over the last few decades because we've gone digital. But I feel like Bitcoin kind of has a way of reversing things. And I think, like, we're gonna see Bitcoin banks and that kind of thing, and they need space. They need to protect the Bitcoin with like a digital, like a fortress, right? Like a Fort Knox for Bitcoin. So I think real estate always ties back in.
Yeah, I think we're just about out of time. Chris, Kenny, any closing thoughts or additional closing thoughts?
Closing thoughts. I mean, just kind of building on Kenny's last points there. I mean, the properties that are worth keeping, right? That you dub, worthy of holding on to for the medium and long term. This is a critical area that you need to explore and figure out how to leverage to the best of your ability. So I think I closed out last week talking about the half dozen different categories that real estate investors and operators were going to have to be able to execute on at a very high level, and energy was one of them. And I think we did a fairly good job today of going in and out of the nuances that solar brings to the table, and just how powerful it can be, from a variety of different vantage points.
Yeah, and I would just kind of say that as an operator, we're always looking to find ways to maximize our net operating income, and solar had been one of the best ways that we had found in decades of searching for ways to increase cash flow. And just seeing digital credit come, it looks like it's going to be more beneficial than solar. It's the new solar. Digital credit's the new solar.
Digital credit. It's the new solar. Well, thank you everyone for listening and watching to today's episode. If this conversation was useful, please share it with someone. Share it with a business partner, a client, somebody that's making real decisions in today's marketplace. New episodes of the Real Estate Standard drop here weekly. So until next time, stay disciplined, think long term, and stack sats. For Chris Drizga and Kenny Alves, I'm Tim Kotzman, and this is the Real Estate Standard. If you enjoyed today's conversation and you own commercial real estate, we'd encourage you to think about how these broader shifts might impact your own property over the next decade. Many owners are starting to reconsider how they structure their balance sheets, manage capital, and position their assets for the future. If you'd like to explore how some of these ideas might apply to your own situation, you're welcome to reach out. We work with property owners and investors to think through strategy, structure, and long-term positioning in a rapidly changing market. You can find our contact information in the show notes. And as